It arrives on any random morning. No warning, no fanfare. Just a plain brown envelope on the doormat, sitting there looking exactly like a council tax reminder or a supermarket flyer. You almost throw it away. But you open it, and inside is a single sheet of paper from your lender that, in polite corporate language, announces something brutal, a pay cut of roughly £5,000 a year. You didn't ask for it. You can't appeal it. Nobody at your workplace decided it. Your bank did. Welcome to the end of cheap bricks. In 2026, millions of British homeowners are opening that exact letter, and it marks the close of the single greatest era of cheap borrowing this country has ever known. Here is the strange part. Nothing about your actual life has changed. Your house is the same house. Your job is the same job. The bricks haven't moved an inch. What has changed, violently, invisibly, is the cost of your debt. Back in the golden era of 2021, a homeowner could lock in a fixed rate of around 1.5%. It felt almost free. Money was practically being given away. Fast forward to today, and the average new 5-year fixed deal sits at around 5%. Your house didn't triple in size, your salary didn't fall off a cliff, but the price of the money underneath your home has more than tripled. Let me put a real number on it, because this is where it stops being abstract. Take a fairly ordinary mortgage of £250,000. Moving from that 1.5% legacy rate up to a 5% fixed deal adds roughly £520 a month in pure interest alone, not capital, not overpayment. Interest. That is £520 a month, vanishing into thin air every single month, simply for the privilege of continuing to live in the home you already own. And that phrase, thin air, is more accurate than you'd think. Living on a 1.5% mortgage was like living at sea level. The air was thick, oxygen everywhere, and you never once thought about breathing. It was effortless. Moving to a 5% mortgage is like being teleported, overnight, to the summit of Mount Everest. The financial air up here is thin. Nothing about the mountain wants to kill you directly, but every single movement now costs you. Buying the weekly groceries takes more effort. Going out for a meal takes more effort. Trying to save even a little takes enormous effort. You are doing the exact same activities you did at sea level, but now you're gasping for breath. That is atmospheric pressure. That is the G-force of a higher rate, pressing down on every ordinary decision you make. So how are Britons coping? Mostly with a mirage. The most popular survival tactic in 2026 is the term stretch. Homeowners who once had a tidy 20-year mortgage are quietly extending it to 25 years, to 30, even to 35. On paper, the monthly payment drops and the panic subsides. But understand exactly what you're doing when you stretch that term. You are not making the house more affordable. You are borrowing years from your future self. You are trading your 60s and your 70s, the decades when you were supposed to be free, retired, and mortgage-less, simply to survive your 30s and 40s. The debt doesn't disappear. It just follows you quietly into old age. And here is the part almost nobody calculates. The opportunity cost. That extra £500 a month you're now handing to the bank isn't just gone. It is money that is no longer compounding for you. In the old era, that same £500 could have been flowing every month into your ISA or your SIP, quietly growing, quietly building the retirement you're going to need. Now it's being redirected, away from your future and into the lender's profit line. Run that forward. £500 a month, lost to interest instead of invested, compounding over 20 years, adds up to more than £280,000 in lost retirement wealth. Think about that for a moment. This isn't simply a higher bill. It is a £280,000 interest tax, draining silently out of a retirement you haven't even reached yet. Here's another way to feel it. In the golden era, you were running a marathon in light summer clothing. You were quick, you were fluid, and life had margin. Now the bank has walked up to you mid-race, handed you a 20-kilogram weighted vest, strapped it tight across your chest, and calmly told you the race hasn't ended. Keep running. And you can keep running. People do. But your financial vitality is being sapped with every single step. The distance is exactly the same. The weight is not. You feel it most sharply the moment the direct debit hits. On any random morning, you glance at the banking app, watch the mortgage payment, leave the account, and do the quiet arithmetic. You realize you are now working from Monday morning all the way to Wednesday afternoon, before you've earned a single penny for yourself. The first half of your week no longer buys you food, or freedom, or fun. It buys you permission to stay in your own home. So what do you actually do about it? This is where strategy separates the survivors from the sinking. First, the danger you must avoid at all costs: the standard variable rate, the SVR. When your fixed deal ends, if you do nothing, if you simply let the letter sit unanswered on the counter, your lender automatically rolls you onto their SVR. And in 2026, that rate sits somewhere between 7 and 8%. This is the financial death zone. On a £250,000 balance, drifting onto the SVR can pile hundreds of pounds a month on top of an already painful jump. Nobody stays here on purpose. People end up here through pure inaction. To escape it, you have two roads. The first is a product transfer. You stay with your current lender and simply move on to a new deal with them. It's fast, it's simple, and crucially, it usually skips a fresh affordability check. The second is a remortgage. You move your entire mortgage across to a new lender, often chasing a sharper rate or a stronger LTV band. This can save you more, but there's a catch. To switch lenders, you must pass their affordability stress test. And here's the trap of 2026. Even though the deal on offer is 5%, banks are stress testing you as though the rate were 7 or even 8%. Many perfectly solvent homeowners are now failing to switch, not because they can't afford 5%, but because they can't prove, on paper, that they could survive 8. So the critical move is timing. You can lock in a new deal up to 6 months before your current one ends. Use that entire window. Waiting until the final week is exactly how people fall into the death zone by accident. And then there's the option the wealthier are quietly taking. They cash out. Homeowners sitting on serious equity, especially across the home counties, where prices ran hottest, are looking at their situation and choosing to sell, bank the equity, and move to a lower-cost region entirely. They're not downsizing out of desperation. They're downsizing to reclaim their margin, swapping an expensive postcode and a heavy balance for a smaller mortgage, genuine breathing room, and a life the Bank of England can no longer reach in and squeeze. Because that, in the end, is the real lesson of 2026. A mortgage was always sold to us as a simple tool, a ladder up into ownership, but in this new era, it has quietly become something else. It has become a gravity test. When your equity is small and your balance is large, every decision the Bank of England makes lands directly on your shoulders, and you feel every fraction of every rate. But when your equity is high enough, when the weight is light enough, something remarkable happens. Their decisions stop reaching you. The rate rises, and your life doesn't so much as flinch. That is the real definition of wealth in 2026. Not a bigger house, not a smarter postcode, just equity high enough that the gravity no longer holds you down. The brown envelope still lands on the doormat, you simply no longer open it with shaking hands. If this video helped you, make sure to like and hit subscribe. I'll see you in the next one.